Hello friends, I have been discussing about the various financial topics from time to time, and today in the same series I have analyzed the financial stability report which was recently released by RBI in June 2026. It is a collective assessment of the FSDC subcommittee of RBI. So going forward, setting the scene, global financial conditions were tested by the West Asia conflict, yet market recovered. India's resilience stood up. The two defining forces which reshaped the global finance include geopolitical fragmentation and AI-driven technological disruption. West Asia conflict triggered sharp initial market reactions. Financial markets have since recovered, supported by lower than expected oil price rise, strong corporate earnings, and AI-driven investment boom. Global stability risks still remain elevated. Inflationary pressures are high, high public debt, and bond market fragilities and growing NBFI footprint is posing serious risk. India's financial system stress indicator FSSI rose modestly but remains among the lowest across comparable crisis episodes in the past 15 years. Global macro financial vulnerabilities. Three amplification channels. Sovereign debt fragility, stretched asset valuations, and leveraged NBFIs, which could turn fresh shocks into systemic events. Bond market fragilities are very high. Government bond yields in selected advanced economies post conflict were very high. OECD's countries refinancing needs reached a record high 20-year high in 2025. Elevated refinancing needs compress fiscal space and amplify the rate shock transmission. Coming to elevated asset valuation, the foreign holdings of US equities in March 26 were up from 7.5 trillion USD in March 2020 to US dollar 21 trillion. US equity private equity ratio, P by E ratio, relative to the historical distribution was at a very high value. AI-linked firms drive the bulk of the index returns in US, Korea, Taiwan. This concentrated the fragility. NBFI leverage risks. Hedge fund gross national gross national exposure to sovereign bonds in 2025 was very high at 18 trillion, which is two times the growth of the figure 9 trillion USD in 2020. Potential fire sale channel under stress. NBFI footprint in sovereign markets continues to grow. India's macro-financial conditions. Coming to India, despite all these global headwinds, India's macroeconomic fundamentals provide strong buffers. But external vulnerabilities require vigilance, continuous vigilance. India remains the fastest growing major economy with inflation within the target as of March 2026. Current account deficit remains within the manageable limits in 2025-26 with consumer price inflation at 5%. Overall balance of payments stayed in the deficit for the second consecutive year due to weak capital flows. External debt to GDP ratio at 20.80%, a manageable level relative to the global fears, reflecting prudential external liability management. As you can see, India GDP growth registered a 7.9% rate, which is the fastest growing major economy. Current account deficit low at 1%, and fiscal deficit to GDP stood at 4.8%. Coming to the banking system in India, which is very sound and resilient as a because of the various steps taken by the regulator and the government of India. Scheduled commercial banks have reached a multi-decadal best as far as their asset quality is concerned, capital level, capitalization, profitability, and they provide a stable foundation for credit-led growth. Gross NPA of the banks stood at a multi-decadal low of 1.8%. Capital to risk assets ratio CRAR was also at a multi-decadal high of 17.7%, with the profit of all the commercial banks taken together stood at 4.05 lakh crore in 2025-26, which is higher than the 3.78 lakh crore registered in 2025 by a huge margin. Liquidity LCR, liquidity coverage ratio, also stood at a healthy 124%. NSFR, net stable funding ratio, that also stood at a very healthy level of 122%, which is well above the regulatory minimum of 100%. Deposit and credit growth gained momentum in second half of the financial year FY26. Net NNPA stood at 0.4%. Provision coverage ratio stood at a healthy 75.6%, and the slippage ratio stood at 1.2%, which is multi-decadal low. Coming to stress test, banks have been built now to withstand huge shocks. As per the stress test undertaken by RBI, even under the severe geopolitical stress scenario, the banking system's capital ratio remains comfortably above the regulatory floors, with only isolated bank-specific vulnerabilities. While the baseline scenario as on March 26 stood at 17.5%, with Common Equity Tier 1 CET1 standing at 15.3%. The adverse scenario 1 In an adverse scenario 1, the CRR may fall to 13.3%, still 4.3% above the minimum regulatory requirement of 9%. And also the Common Equity Tier 1 CET1 remains much above the 5.5% level. In the adverse scenario 2, which is most severe stress condition, CRAR may fall further to 13%. Gross NPA may rise from 1.8% to 4.1%, but still they are manageable and no breach of minimum capital happens during this process. Even a 2 standard deviation shock, pushing the gross NPA to 8.1%, still keeps the system level capital above regulatory minimum. Coming to NBFC and non-bank sector, which are resilient, but watch points remain. The NBFC sector demonstrates resilience with improving asset quality, as can be seen from the presentation, but rising fintech delinquencies, microfinance recovery, and interconnectedness merit a closer watch. CRAR of the NBFIs stood at a very high, healthy level of 24.6%, with net NPA 0.8%, return on assets 2.3%, and 16.6% credit growth year on year. Gold loans at 17.4% of the retail portfolio. MSME credit remains robust, with gross NPA improving to 3.1%. Microfinance credit from NBFCs and NBFC MFIs expanded 5.9% in H2 2025-26. Gold loans now represent 17.4% of NBFC's retail portfolio, concentration risks are needed to be monitored. Contagion check. Failure of the largest NBFC could erode 3.1% of the banking system Tier 1 capital. Still, it is manageable. No bank breaches minimum capital requirement. Microfinance is recovering. Sector is expanding again after the stress. Asset quality trajectory merits sustained monitoring. Interconnectedness is one of the concerns. NBFCs are the largest net borrowers. Gross payable 26.57 trillion rupees. Over 57.7% of it is funded by the scheduled commercial banks. A channel for shock transmission remains. Coming to the interconnectedness, the financial system interconnected and network risk. Deeper financial integration enhances the efficiency but creates additional channels for shock transmission. AMC mutual funds are the largest net provider of the funds, gross receivable of 23.95 trillion rupees. Scheduled commercial banks, private sector banks are the main primary recipients. NBFCs are the largest net borrowers with gross payables at 26.57 lakh crore. Over 57.7% of their funding is sourced from scheduled commercial banks, creating a concentration linkage. Banking network, five banks from the inner circle, comprising all PSBs and private banks. Periphery is occupied by the foreign banks, urban cooperative banks, and small finance banks. Insurance sector remains healthy. Solvency buffers of the top life and general insurers remain well above the regulatory minimum across scenario analysis. Mutual funds and clearing corporation stress tests also confirm the resilience. The weak point is that increasing interconnectedness could act as an amplification channel under a stress scenario. It merits enhanced surveillance and calibrated oversight. Regulatory priorities, building resilience and deepening the market. Global focus is on Basel III implementation, strengthening NBFI structural vulnerability reduction, digital asset frameworks, climate finance standards, and AI governance. RBI domestic initiatives has also a number of initiatives have been taken, which include Basel III capital charge for the credit risks by standardized approach directions, April 2026, CRR SLR amendment directions 2026. Customer protection and inclusion, technology and e-enabled, a technology-enabled KYC, financial sector cybersecurity strategy, RBIOS 2021, complaint resolution, Swagat FI framework for FPIs and FBCIs. SEBI has also taken a number of initiatives which include Project Sudarshan, which is an AI-driven fraud detection, verified level for stock trading apps, SMREIT, real estate investment trust and social stock exchange developments have also happened. Regarding IRDA, Ind AS implementation in insurance is being undertaken, policyholders' education and protection funds being constituted, health and insurance systemic issue measures are being taken. Key takeaways, strength, opportunity, and watch points. Strength includes multi-decadal best capital and asset quality indicators. Stress tests confirm capacity to withstand a very significant adverse shock environment. CRR is 17.7%, a very high level. Gross NP is a multi-decadal low of 1.8%. Profit after tax 4.05 trillion rupees. Even severe stress scenarios, the system level capital ratios remain above regulatory minimum. Opportunity, Opportunity is AI-driven productivity gains, creating investment and efficiency opportunities across sectors. Robust MSME credit and deepening capital markets support medium-term growth momentum. Growing mutual fund industry with resilient SIP flows provide a long-term financing depth. What are the watch points? Global bond market fragility and potential financing condition tightening, AI equity concentration and valuation risk spill over to emerging markets, fintech delinquencies, unsecured small ticket loans ranging from rising to 6.4% in the default past due period of 90 to 179 days. Rising NBFI interconnectedness is potential shock amplification channel and cyber risk. AI enabled attacks emerging as the most important near term threat. So, this entire presentation was based on the financial stability report. If you like the presentation, please like and share. Thanks for your kind attention. Jai Hind.